Okay, so picture this. You have a company that's been a Wall Street darling for decades, a near monopoly, an absolute titan in its field. Now, imagine its stock price suddenly just falls off a cliff. Well, that's exactly the story of FICO, and today we're going to figure out what on earth is going on.
So, what could possibly shake a giant like FICO? What could cause a nearly 30% drop in its stock seemingly overnight? That is the billion-dollar question we're going to dig into right now. And just to put this collapse into perspective, FICO went from being valued at 80 times its expected future earnings. That's a sign of massive investor confidence, all the way down to just 25 times. You can see the difference right here. The market's entire view of FICO's future has been turned completely on its head.
All right, so where did the cracks in this fortress even begin to appear? To really get that, first we need to understand what makes FICO tick.
FICO really has two main business lines, but let's make no mistake. One of them is the undisputed king. A staggering 80% of its profits come from its famous scores business. This means any threat to the scores business isn't just some minor problem, it's basically a threat to its very existence.
And a threat is exactly what showed up, in the form of a surprisingly cheap and very direct new competitor.
So, for the first time in decades, FICO's monopoly was officially shattered. In a huge move, government agencies Fannie Mae and Freddie Mac basically gave lenders the green light to use a rival, VantageScore. All of a sudden, FICO wasn't the only game in town for mortgages anymore. And here's where the rubber really meets the road, financially. A huge part of FICO's growth recently came from just jacking up prices, from 60 cents a few years ago to nearly $5 today. But now, with VantageScore entering the ring at just 99 cents, FICO's ability to keep raising prices has just hit a brick wall. But here's the thing. That threat from VantageScore, as big as it is really just the tip of the iceberg. The deeper, maybe more fundamental challenge to FICO comes from a force that's reshaping, well, pretty much everything, the rise of artificial intelligence. You've got this new wave of fintech companies coming in and asking a really revolutionary question. In the age of AI, do we even need FICO scores anymore? Companies like Upstart and Affirm are building their own super sophisticated AI models to figure out risk. This isn't just competition, it's a direct challenge to FICO's entire reason for being.
And listen, this isn't just some fringe opinion. Morningstar, one of the most respected research firms out there, they put it bluntly. They're basically saying that the core of FICO's business, the part that decides if you get a loan, no longer has a strong, defensible advantage, or moat, in the face of all this new tech.
Okay, so the situation looks pretty dire, right? You've got a cheap rival and the disruptive power of AI. But hold on, this is where the story takes a really fascinating, unexpected turn. Turns out, FICO has a hidden strength, a kind of secret weapon that the market seems to have completely overlooked.
And that secret weapon is one word: benchmarking. So what on earth is that? Well, think of the FICO score as the universal language of credit. It's like English in international business. Even if a lender uses their own fancy AI model to approve a loan, they still need a way to tell the rest of the financial world how good that loan is. And FICO is that common language.
And this, right here, is the absolute key to understanding why FICO is so resilient. Because it's the industry standard for benchmarking, the FICO score becomes, as one analyst put it, effectively unavoidable. Lenders are almost forced to use it, not for the initial decision, but for everything that happens after.
Let's look at a real-world example to make this concrete. CarMax says the FICO score isn't a huge factor in their own models for approving car loans. But, and this is the kicker, when they package those loans up to sell to other investors, they still have to report the average FICO score of the borrowers. They need FICO to speak the language of the market. They simply can't avoid it.
So what are we left with? We have these two powerful opposing forces, very real threats on one side, and this incredibly strong hidden moat on the other. So what does this all mean for investors? Could this massive stock drop actually be a once-in-a-generation buying opportunity? Now let's be clear, the risks are absolutely real. That 99-cent VantageScore definitely puts a cap on FICO's pricing power, and the rise of AI absolutely challenges FICO's traditional role. The stock deserved to take a hit. That old valuation just wasn't justifiable anymore.
But what does FICO's own management think? In the world of investing, actions speak way louder than words. FICO's leadership just took out a new billion-dollar loan, and they're using a massive $600 million chunk of it to buy back their own stock. That is a huge vote of confidence. It's a powerful signal that they think the market has it all wrong.
So how can we actually try to value FICO with all this in mind? This model uses pretty conservative assumptions. It projects strong growth in 2026, probably from price hikes already in the pipeline. But then it assumes a big slowdown to 20% and then 15% growth to account for all that new competition. And crucially, it assigns a target price-to-earnings multiple of 25, which is way below its historical average, reflecting that increased risk.
And even with all those conservative assumptions, what does the model spit out? A fair value estimate of around $1,000 per share.
So what does a $1,000 price target actually mean for an investor? Well, it suggests a potential annual return of about 15% from today's price. To put that another way, that's enough to roughly double your money over the next 5 years.
This whole story really comes back to a timeless investing principle. There's no doubt FICO is a high-quality company. But even the best company in the world can be a terrible investment if you pay too much for it. This recent stock crash has fundamentally changed the what we pay part of the equation, and that might just turn a great company into a great investment.
Which brings us right back to our big question. Is FICO a flawed giant, a relic getting disrupted by new tech and competition? Or is it a misunderstood bargain, where the market panicked and completely missed the power of its hidden moat? The answer isn't just about one company's future. It's about how we value durable, old-school strengths in an age of constant disruption.